Hey everyone, welcome back to our channel where we break down investing and trading concepts into easy to understand tips for beginners. I'm Soh. In this video, we are diving into a frequently asked question. What's the difference between ETFs and futures trading, and which one should you choose? So whether you are a beginner or just looking to sharpen your investing knowledge, this video is for you. And before we get into it, be sure you hit that subscribe button and turn on the notification bell so you don't miss out on any of our informative updates. Thanks for tuning in. So let's get started. First up, let's talk about ETFs. ETF stands for Exchange Traded Fund. If you are familiar with mutual funds, you are already halfway there. Like mutual funds, ETFs are a collection of different stocks, bonds, and other assets bundled together in a basket of funds. Now, this means when you buy a share of ETF, you are actually buying a small piece of this diversified basket. However, unlike mutual funds, which are bought and sold at the end of trading day, ETFs are generally traded on the stock exchange throughout the whole day, just like individual stocks. Now, this means you can buy and sell them at market price whenever the stock market is open, so it gives you more flexibility. The good thing about ETFs is that they offer diversification. Now imagine you want to invest in an index, but buying shares of every major index linked company is expensive, right? So instead, you can buy an index ETF that includes all index linked companies. Now, this way, if one stock does not perform well, the other in the basket can balance it out. But here's something important to keep in mind. ETFs comes with management fees, and these fees cover the cost of managing the ETF funds and are usually expressed as an expense ratio. So while these fees are typically low, it's lower than mutual fund. They add up, when they add up over time. So it's something to consider when choosing an ETF. Another key point about ETFs is that their investment strategy. So ETFs typically they use a passive buy and hold investment strategy, and generally it aims to track the performance of their benchmark index regardless of the state of the overall markets. So it makes them suitable for long-term investors. Now this strategy involves buying ETF shares and holding them for an extended period of time so that it is able to capitalize on the growth of the underlying assets over time. Now, let's flip the coin and talk about futures trading. Futures are contracts that obligate the buyer to purchase or the seller to sell a particular asset at a predetermined price at a specific time in the future. So futures is not about owning that actual asset, but rather it's more about speculating on the price movement of that particular asset. So for example, if you are thinking of the value of FPM KLCI index will go up in the next 3 months, you can buy an FKLI futures contract. So if your anticipation is correct, you can sell the contract for a profit. Besides that, futures are often used for commodities like oil, gold, or agriculture products such as the crude palm oil. But you can also trade futures for financial instruments like stocks, indices, or currencies. The futures market include a variety of participants such as hedgers, speculators, and arbitrageurs. Hedgers usually use futures contract to protect against price changes in that underlying asset. Speculators like you and I as retail traders, we aim to profit from price movements. And arbitrageurs, they look to exploit price differences between markets. Futures trading can involve strategies like trend trading, hedging, arbitraging, and many other advanced techniques, making it a powerful tool for different trading goals. So how do these two instruments compare? Let's break it down into a few key points. First one, on ownership. Now, for ETFs, when you buy an ETF, you own the share of the fund, which in turn owns the underlying assets. Now, this means you have a stake in all the assets within the ETF, like stocks, bonds, or other investments. It's like owning a tiny fraction of each asset in the fund. Whereas for futures, with futures, you don't own an actual asset. Instead, you own a contract that represents an agreement to buy or sell the particular asset at a future date. Now, this is can be purely speculative, where you bet on the price movements of asset without ever owning it. The second thing, on leverage, ETFs are typically bought without leverage. So this means when you buy an ETF, you're actually paying the full price of shares upfront. If you have $1,000, you can only buy 1,000 worth of ETF shares. But for futures trading involves leverage, allowing you to control a large contract value with just only relatively small amount of money, known as the initial margin. Now, for example, with $1,000, you might be able to control futures contract that is worth $10,000 or more. Now, this leverage can magnify your gains, but it can also magnify your losses, which makes futures a little bit riskier. Of course, with risk, it comes with a return. The third thing, on risk. Now, for ETFs, generally considered lower risk compared to futures because they offer diversification. If one stock in the ETF performs poorly, others might performing well. So it balancing the overall performance. However, ETFs still carry market risk, meaning when the overall market is down, their value can go down based on the market conditions. For futures are has higher risk because of the leverage involved and the speculative nature of the contract. Now, prices can move very quickly and dramatically in futures, and if the market move against your position, you may be lose more than your initial investment because it involves leverage. Now, this means futures is more suitable for a more experienced trader who can handle a higher volatility. The next thing that differentiates ETFs and futures is on the management fees. Now, for ETFs comes with management fees, generally known as the expense ratio. This covers the cost of managing the fund. So these fees can vary, but generally are low, ranging from 0.03%. It can be up to 1% annually. So overall, these fees can impact your overall returns. So it's important to compare the expense ratio of different ETFs. For futures, it does not have a management fee at all, but just like any other regular tradings, you may incur brokerage fees, commissions, and other trading costs. So these fees, it can add up, especially if you trade very frequently. And lastly, on liquidity. For ETFs, generally they are quite fairly liquid, meaning you can buy and sell them easily on the stock exchange at the market price during trading hours. Now, this makes ETFs a convenient option for investors who need quick access to their money. Futures can also be highly liquid. Of course, it depends on the contract and the market. And in fact, for some popular futures contract, especially for those major stock indices like FKLI or popular commodities like FCPO, they can have higher liquidity compared to ETFs, meaning they can be bought and sold easily with a small bid and ask spread. However, lesser popular contracts may have lower liquidity, making it harder to enter or exit a position without affecting the price. Alright, we have laid out the differences. So which one should you choose? Well, it really depends on your investment goals and risk tolerance. If you are looking for a long-term investment and prefer something more stable and easier to manage, then ETFs are a great choice. They provide diversification and are suitable for beginners who want to invest in a sector or an index without picking individual stocks. Of course, with lower risk, the return would be lower as well. And if you are a more experienced trader and investor, you are willing to take more on higher risk and are looking for short-term opportunities, then futures trading might be for you. Futures can offer significant returns due to their leverage effect, but they requires a deep understanding of the market and a higher risk appetite. But if you have a good trading system, then futures trading can be quite easy to manage as well, and it provides a lucrative return. So before making any decisions, it's essential for you to do your research and understand your investment goals, assess your risk tolerance, and maybe even consult with a financial or a trading coach. Remember, every investment comes with its own set of risk and rewards. So that's all for today. Thanks for tuning in. If you find this video informative and helpful, don't forget to like, subscribe, and hit on the notification bell for more updates on investment and trading videos. Good luck and good trading.